Have you heard that you don't need long-term care insurance, especially if you can self-insure? Have you been told it is too expensive and it's not worth it?
Have you also heard that Original Medicare or your Medicare Advantage plan covers long-term care? Well, if so, in today's video, we'll show you the 5 most common myths regarding not buying long-term care. And most importantly, do you really need it? And is it even worth it?
And if you're considering self-insuring, stay tuned to the end where we will show you 3 hybrid options to consider without ever buying a traditional long-term care policy. Hi, I'm Chung.
And I'm Chung. Now, before we discuss the 5 myths, please push the like button and subscribe. It only takes a quick click, and that really helps our channel grow and keeps these videos coming every week. Now, as a thank you, here's Gracie attempting to do her downward dog in her new red sweater.
She's so cute. Okay, let's first discuss the 5 myths about why many feel long-term care is unnecessary. Myth number 1. Most people never need long-term care, and the average stay is only 2.5 years. The U.S. Department of Health and Human Services reports that someone turning 65 today has almost a 70% chance of needing some type of long-term care service and support in their remaining years. By 2050, up to 30 million people in the Americas will require long-term care services.
Yes, did you notice the fact is 70% will need some type of long-term care?
But what about this? Only 4% of U.S. seniors live in nursing homes.
So is there a contradiction? What statistics can you believe in?
Well, the reason for all the confusion is not understanding the definition of long-term care. The definition of long-term care is when someone needs assistance for at least 2 activities of daily living, such as bathing and dressing.
Yes, the key words are 2 activities. Now, if you're in a nursing home, most likely you cannot perform 3 or 4 of the activities of daily living. So when you're reading those biased articles against buying long-term care, notice carefully that they do not discuss home or assisted living care.
So 70% includes all levels of care, not just nursing home care.
That's right. One comparison I would like you to think about is your home insurance. Now, if you have a mortgage, there's no requirement saying that you have to keep your home insurance policy. Here are the stats. 0.01% to 0.002% will file a claim related to water, fire, or any type of liability. So compare that to the whopping 70% for long-term care. So for everyone that has a home paid off, just cancel your home insurance policy. No, I'm not serious.
No, of course not. We're not promoting canceling your home insurance policy. But if you're not comfortable taking the risk of canceling your home insurance policy, and the statistics are not even half of 1%, then why would you consider not buying long-term care insurance when the odds are against you at 70%?
Yeah, especially since there are 3 types of hybrid options that can help you pay for your long-term care, which we'll discuss in a bit. Now, think about this question. Would your financial advisor or accountant ever suggest to cancel your home insurance policy since you have no mortgage and you have a sizable retirement? Of course not.
No. Okay, let's discuss the fact that the average stay in the nursing home is only 2.5 years. Think of any of your friends that need care at home or assisted living care. Think of how many years of care they needed before entering a nursing home. Some never even going to a nursing home. Again, this percentage is only 4%.
Remember, it's not uncommon for someone to receive care at home for several months or longer, followed by a couple of years or even 5 years or longer in an assisted living. Now, all combined, the total number of years could be 5 to 8 years of long-term care.
One of our team members worked at a local assisted living before she started working with us. She had seen many patients in the facility from 5 to 15 years. Even a patient has become a good friend to her has now been there for over 16 years. So please do not believe the math of only 2.5 years. That statistic is only true for nursing homes.
Here's another fact to consider. There are no more long-term care coverages, traditional or hybrids, except for one, that sell lifetime benefits. Now, why is this point significant? Insurance companies are in it to make money. Now, if they can sell you lifetime benefits and charge you extra premium for something that you never need, then why wouldn't every insurance company keep selling long-term care, especially with lifetime benefits?
Plus, most traditional long-term care companies are no longer selling long-term care. There are also only a few hybrid plans out there. Here are some more statistics. About 2% of US seniors live in assisted living facilities. 65% of people use in-home care services.
Now, did you notice the last point? 65% will use in-home support services. So saying 2.5 years is the average stay for long-term care is not true. So a transparent statement would be that only 4% go into a nursing home for 2.5 years on average. But this statistic does not include home or assisted living care. Long-term care refers to all levels of care, especially starting from your home.
Yes, very few people go from being healthy straight to a nursing home and then pass away. Most stay at home first.
Now, I don't know about you, but I'm not going into a nursing home.
So you're saying I'm your long-term care then?
No, I didn't say that. We have long-term care already, so we'll talk about that in a minute. Folks, get the right facts. If you only read or been told that magical 2.5 year mark, then your retirement portfolio or legacy may have a tragic ending. Now, most of us, yes, 70% of us will use some form of long-term care, whether it's home, assisted living, or nursing home.
Now let's talk about myth number 2. If you have enough assets, just self-insure. Have you been told if you have over $500,000 that you don't need to buy long-term care? Let's combine the average stay with a home and assisted living care and not include nursing homes. Why are we not including nursing homes? Because only 4% of us will be going to a nursing home anyway. And I'm sure you're saying to yourself, there's no way in the world I'm ever going into a nursing home.
Here's the average cost. With the annual cost of $54,000 and the combination of home and assisted living care being 5 to 8 years, the average cost is $270,000 to $432,000. Now here's a map of the most and least expensive areas for long-term care, specifically assisted living care. Now, combine that with the rising cost from 2011 to 2021, the cost has gone up 38%. This means the average annual cost 20 years from now could be $102,000 per year. So for 5 years, that would be equal to $510,000. And for 8 years, that would be $816,000. Now, for the more expensive states, that would be around $800,000 to almost $1.3 million. Now, for those of us in the California Bay Area, we can add another 20% to those costs.
This reminds me of a client that we had for Medicare. When we first met with them, they had over $2.5 million.
That's right.
When we met the younger wife for her Medicare a few years later, they only had $250,000 left. Now, how did that happen? Her husband was at home for over 10 years and later was in assisted living for another 3 years. He only stayed in a nursing home for less than a year.
I remember that one. And my own mother took care of my grandmother for around 8 years at home before she ever went into a nursing home for only 1.5 years. Yes, friends, this is the true cost and time frame for long-term care.
And here's a key point to consider. Guaranteed income is more important than your asset size.
Uh-oh. We know that there are many well-respected financial advisors that would disagree with this statement. However, here's the proof. The average teacher, government, or union retiree retires with 80% to 100% of their income, assuming that they've been working there for 30 to 40 years. So to give you real examples, our teachers here in the California Bay Area retire with around $8,000 to $10,000 per month, depending on the school district. Now, a superintendent that's a client of ours retired with a salary of $22,000 per month, which is basically his salary he had before. A government retiree, depending on their position, retires with $6,000 to $12,000 per month. Here in the Bay Area, we have one of the highest costs of assisted living, around $8,000 to $12,000 per month.
And most of those with a pension only have around $100,000 to $300,000 in their 403B or 457, which is like a 401k.
So here's a question we would like you to get your opinion. Who needs long-term care insurance more? The person with a nice pension and very little in their cash assets? Or a person with no pension and 1 to 2 million in their liquid assets? Now, before you answer that, consider how much one loses in salary in their retirement. If one has a large 401k, most likely they had a salary close to $100,000 or even up to $150,000. Now, the average Social Security is only around $30,000. So if you wanted to keep the same lifestyle, you might need to take out another $50,000 or $100,000 to supplement your Social Security per year. Now, if you live only 20 more years in retirement, you would have spent $1 to $2 million. And this is just for one person. And this is not even including inflation. So ask yourself this question: how much would you have left to self-insure your own long-term care?
Let us know what you think. Who's better off, the person that retires with 80 to 100% of their salary, or the person with no pension and over $1 million in their retirement?
Now, what if you have a sizable asset size, like $3 million and up? Stay tuned. We will discuss the 3 hybrids in a bit, especially the self-insure type of hybrids.
Let's move on to myth number 3. Don't buy long-term care until you're 60 or older. The argument for that is the chances of you needing long-term care before 60 is slim to none. Also, you're paying extra for years you don't need. While that's true, did those articles say that your premiums would be double or triple that compared to your 40s or 50s? Did they consider this most important fact? Your health will most likely change. If you purchase a policy when you are younger, not only will it be less expensive, but you'll get the best preferred rate.
Yeah, we preach what we teach. We actually bought our coverage at 27 years old. Now, yes, if we do the math, it was better if we waited until our 40s. However, we got the best rate for around $60 per month, and we have a return of premium rider, which means if we never use it, then the money goes to our beneficiaries, which they no longer sell, by the way.
So buying earlier many times will also give you better coverage and features than waiting later.
Now, here's another key factor to consider. If you're going to wait until your 60s to buy long-term care, for the argument that you're not going to use it before your 60s, then most people should never buy life insurance until after 60 because they're most likely not going to die before 60. No, that sounds ridiculous, doesn't it?
Okay, so let's now go to myth number 4. Your Medicare or Medicare Advantage plan covers long-term care.
No, it does not. Why are you telling people that? I wish I had my buzzer right now. No, to be super clear, original Medicare and Medicare Advantage plans cover short-term care. For example, 20 days for free in a skilled nursing home and a share cost from day 21 to 100 days.
Here's a link from Medicare.gov, and notice what it says it covers and does not cover. Care such as part-time or intermittent skilled nursing care, physical therapy, occupational therapy, and so forth. What original Medicare and most Advantage plans do not cover is 24-hour-a-day care at your home, meals delivered to your home, homemaker services like shopping, cleaning, and laundry that aren't related to your care plan, custodial or personal care that helps you with daily living activities like bathing, dressing, or using the bathroom.
What the? I mean, think about this. Most of us, 65% of us, will need those services, and that's when we want to stay at home or at least a nice assisted living care. Yes, there you have it. Medicare covers short-term care, not long-term care.
Lastly, myth number 5. Don't buy long-term care because the rate increases are gigantic and there are many increases. Again, there's some truth to that statement. Some companies have raised their rates by over 50% multiple times. Now, we've had our long-term care plan for over 15 years now, and we've only had one increase of only 20%. So this statement is not true with good, highly rated companies. Most importantly, there is never an increase in most hybrid policies.
Yeah, let's discuss the 3 hybrids that you can look into, whether you have a lot of cash flow or not. The first hybrid is one that most can afford, the monthly premium hybrid plans. Now, these plans, you keep paying until you use the plan. Yes, you actually stop paying once you go on claim. But here's the key point of this hybrid plan. If you do not use the plan and you pass away, your beneficiaries will get a lump sum death benefit that is tax-free. Yes, this is a long-term care life insurance hybrid.
But be careful. There are many life insurance hybrids with a chronic illness rider, not a long-term care rider. Now, what's the difference? Well, subscribe and turn on the notifications bell to be notified for our future videos regarding this.
The second hybrid is asset-based long-term care policies. Now, the best way to explain this, imagine you walked into the bank and they offered you a savings account. And they said, as long as you keep your money in the account, they will cover your long-term care, including home and assisted living care. And if you never use it, they will give the money and more as a tax-free death benefit. Typically, they actually double or even triple what you put into the account. Now, similar to the other one we discussed, you will get that account or that money tax-free to your beneficiary.
But if you decide you want to cash out, the money is always available with no surrender charges. Yes, completely liquid with no penalty for early withdrawals.
Now, so in summary, this is an alternative to self-insuring by using a lump sum cash value that is always in your control, whether it's a regular savings account or IRA. Now, what are the pros and cons? Again, subscribe to our channel and we'll make sure that you get our future videos regarding this topic.
Lastly, the hybrid that everyone can afford.
Everyone that has a 401k or some kind of savings.
Yes, this is our favorite option, a pension hybrid. This is where you take your own savings, cash, 401k or IRA, and convert that into a pension hybrid.
Here's how it works. Let's imagine this purse.
Oh, here's my purse again.
We have another video that you can watch this. Let's imagine that this purse here is Anne's $1 million savings or 401k.
Yes, my money.
Again, we live in a community property state. This is our money.
Right, in this example, it's my money. Here we go again.
Okay, never argue with a wife. Now, with a pension hybrid, she can cash out anytime since this is, yes, her money. Okay. Now, however, if she adds this paper called a lifetime income as a rider, just like you may have a home insurance policy rider called an umbrella policy, well, this rider, she will get this income for life if she passes away prematurely. The lifetime income now will actually stop, but the beneficiaries will inherit this asset just like any savings account or IRA account. But here's a critical point. If she depletes all of her money, yeah, told you didn't have any money there.
It's in there somewhere.
She will have this income for the rest of her life. And no, we're not talking about an immediate annuity or annuitizing your money. When you do that, you will no longer have this asset. You actually give the control of this asset to the insurance company, and you'll never have control over your asset again. So we're not talking about those annuities. As you can see, there are two parts here. That's why we call it a pension, lifetime income, hybrid, total asset control.
To be clear, what he mentioned is not long-term care insurance.
Right.
Rather, any guaranteed income you can use to self-insure your own long-term care. So what are the pros and cons compared to the other two hybrids? Again, watch out for our future videos.
So how does this relate to home or assisted living care? Think of anyone with, say, a nice pension, just a traditional pension. A pension is an insurance policy that guarantees income for any expenses like Anne mentioned. But what we love about these pension hybrids is that you do not need to file a claim or prove you cannot perform those two activities of daily living.
Right, so if you're still healthy, but maybe just tired and would like to hire your own butler, a cook, a maid, a driver, you can, especially since the income is guaranteed for life.
You really want your butler, don't you?
Sure, who doesn't? So the only people that really should not buy long-term care are those who have no assets and very low incomes, since they can qualify through the state Medicaid program.
Otherwise, as stated above, with a 70% chance of needing some type of home or assisted living care, again, we don't like to talk about nursing home, not buying any plan is too high of a risk, just like we all have home insurance policies. If you're considering to self-insure because you have enough assets, at least consider one of these three hybrid options we just mentioned. Would you like to learn more and have more details about these hybrids? Click on this playlist here to learn more about pension hybrids, and subscribe to our channel to watch our future videos on these three hybrids and the pros and cons of each hybrid regarding long-term care.
And in the meantime, feel free to call us to learn more, and we will be happy to customize a hybrid plan to fit your needs.